The markets have been moving in this wedge formation now for the last few months, and that's been enhanced by the fact that the market direction is absolutely sideways. Today, the Dow was down 28 points after opening up and was up about 100 points at one time. And you can see what the direction is. It's been sitting right on the T-line, absolutely flat, still providing this wedge formation as it's being the predominant trend indicator. What that does, though, is that because there's no strong force one direction or the other, it reacts, allows the investor sentiment to react because there is no forceful direction based upon daily or almost hourly news items. So right now, the market has been moving sideways in this wedge formation. And unfortunately, Amazon has missed their earnings and trading way lower, which will probably put more of a negative cast on the market indexes tomorrow, continuing to move it sideways in this wedge formation. However, the NASDAQ has also been in this wedge formation without any major direction, except today with it closing positive, it's pushing on this upper level of this wedge, which means because they haven't been able to close it below the T-line, if they start trading at positive tomorrow, even in spite of the Amazon report, that tells you we might now be breaking out into another strong wave to the upside. That same analysis can be applied to the S&P 500, which also has been staying above the T-line and starting to push toward this upper resistance level. If it breaks out through here, the last 2 or 3 months where we've been moving sideways, maybe even 4 or 5 months moving sideways, can now tell us that the consolidation of the markets are over. The next wave to the upside is in progress. Because of the whipsaw or the indecisive trading of the overall market, the candlestick investor has the benefit of being able to identify patterns and continue to hold a position with one simple T-line rule, that as long as you stay above the T-line, you can stay long. This allows for the lack of being whipsawed in and out of positions with that simple rule. This was our recommendation on HOV, one of the home builders. The auto parts stocks have been acting well ever since their bounce up off the 50, like in our recommendation on TEN. You can see how they gapped up through the 50, through the T-line, did a doji sandwich, and all we have to do is stay long right now as long as it continues to stay above the T-line. The same scenario applied to our recommendation on Dana Auto Parts. You can see how they were gapping it up through the resistance levels above the T-line. All you have to do now is stay long with the anticipation that wave 1 and wave 3 will be about the same, taking you up to the target of the 200-day moving average. This is not rocket science. This is basically identifying what the Japanese race traders illustrated to us as being very strong reversal signals, especially coming out of the oversold condition, and just staying long until you see a sell signal and a close below the T-line. That'll be it. We'll see you in the chat rooms.